Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
It's a little bit after the hour. Good morning, everyone. Show's called Your Money, Your Wealth. Joe Anderson here. I'm a certified financial planner. I'm with Mr. Alan Clopine. He's a CPA. Thanks for tuning in. Next few hours, we got a lot of stuff to get through in a short period of time. We got 2 hours now.
We do, yeah.
Get through all this.
You think we can get through all this in 2 hours?
I think so.
Because we got a lot of stuff here.
You know, we got stacks and stacks of paper. And I just found something out, is that Alan has a little bit of OCD. Because my area...
It took you 10 years to figure that out?
Because my area is a little bit messy. And Alan's
mine
is very neat.
Everything's at the right angle.
Right, it is. You're just ready to go. I'm just going to just throw stuff out there. And you're going to get all messed up. You'll be like, wait a minute.
Hey, that wasn't on the schedule.
That wasn't on the schedule. That was not on the agenda.
Yeah.
A few things here before we dive in, Al, is that this whole Department of Labor deal.
Oh, boy. You're going to go there, huh?
I just want to vent for just 30 seconds.
Okay.
And it's a really good thing, right? I think it's that, all right, well, now for retirement plans, and this is not going to happen until probably 2018 if it does happen.
Well, yeah. I mean, I guess the insurance companies are already fighting it, but it's supposed to start at least somewhat by April of 2017.
Okay. And basically for your IRAs and 401ks and things like that, is that there's now a fiduciary standard.
Yeah, which means that your advisor has to act in your best interest, not just their best interest, which you would think is already the case, but actually it's not.
I think it is in most cases.
I think most people most advisors are honest, yes, but we have a system that doesn't necessarily require the advisor to put the client first.
But here's the problem, I think, is that they're focusing maybe on the wrong thing, in a sense. Okay. Because now I'm hearing, because I listen to a lot of podcasts, I listen to the radio, you know, and the commercials and all the different and our firm, Pure Financial Advisors, full disclosure, is a fee-only fiduciary. We're a fee-only financial planning firm. We don't sell any products. There's never a commission generated to our firm. But I mean, I think what we want to hang our hat on is the strategy that we put together for our clients, right?
Yeah.
Because I hear this, you know, hey, well, I'm a fiduciary, you got to work with me, and he doesn't know his head from his behind. You know what I mean? And so now people will probably hire, and if it's a commission broker that knows financial planning, that can help people out with their Social Security strategies, to create the retirement income, to save money in taxes, you know what I mean? Dalbar just came out with a study, right? So they do this every year, and they take a look at the average investment versus the average investor return. And so over the last 30 years, the S&P or just call it the U.S. stock market has performed, and I'm going to just do rough numbers, about 10.5%, while the average investor does 3.5%.
Right.
So it's a 6% differential here, 7% differential, right? So what is going on? I talk about this in the classes that I teach, is that I go through all the different products available. You can go to a mutual fund. You can go to exchange-traded fund, index funds, a separate managed account, to an annuity, to whatever, right? The good, the bad, the ugly of all the different products. But at the end of the day, it doesn't really matter what product people get into, because it's their own detriment that they blow themselves up.
Yeah, it actually becomes less important, right? Because, I mean, so retail mutual fund,
I'm paying 1.5% in fees versus 20 bips in fees.
That's right.
But I'm still losing 6% of the market because I'm getting out of the market at the wrong time.
That's exactly right. You could save 1% by getting into low-cost funds, but if you're getting in and out at the wrong time, as you just showed us, it's a 6 or 7% problem.
So I'm listening to this podcast. This guy's fee-only advisor does not have any credentials, right? And he's a DFA advisor, so I understand the investment philosophy very well. But he's taking calls on his radio program, right? And so, you know, this lady's calling in, and she's like, I just retired, and I want to put my money into a Roth IRA. Oh, no, you can't put any money into a Roth IRA. You need earned income. And I'm pulling my hair out. I'm like, how can you give advice on the radio when you don't even know the tax law?
Right.
And then he's like, well, tell me more. Well, do you already have money in a Roth? Yeah, I have $30,000 in a Roth IRA. Well, where's it held? Well, it's at Primerica. Oh, my God, you got to get the hell out of that. You're paying way too much in fees. And I'm like, whatever. So I think now people are using this whole fiduciary as a marketing ploy in a sense.
Right. I would agree with you.
Where it's like, okay, well, here, I think people should look at, all right, what is the competency level of the individual given the advice?
Right.
Right. And then have full disclosure if they get paid a commission, if they get paid a fee, if they get paid whatever. Right. And then work on it on that basis.
Yeah,
Look for a credentialed professional, a
Yeah.
CPA, a CFA, a certified financial planner, right, a chartered financial consultant or something like that that has the knowledge in the background to help people grow and understand where they need to put their money to get the best bang out of their buck.
Yeah, I guess the way I like to say it is you start with a fee-only fiduciary firm, but that's just the foundation. I mean, over and above that is the quality of the advice, as you just said, Joe. And it's you want to have an advisor that can really understand cash flow needs throughout retirement, taxes, to save money in taxes, and then how the investments all fit together. And you want an advisor that's going to be kind of a coach for you, a quarterback, if you will, because you can set up a plan and 6 months later everything changes. You know, this happens that wasn't expected. Maybe you thought you were going to work till age 67 and you're 61 and you got laid off. Right? And so, okay, we got to rework the plan. You need to have an advisor that really understands all this thing. And you're right, this new Department of Labor rule, so it's all about trying to get everyone, all the advisors, to be fiduciaries, to look out in their client's best interest.
Which I think is admirable. I think that's the right direction.
Which is right, correct. But that is not the end all, and I think that's what you're saying.
Correct.
That's, to me, that's the starting point. Then it's like, all right, now that we're kind of getting a little bit more on the same page. We're all acting as fiduciaries, and which we've been acting for decades, but that's another story. But at any rate, it's all about the advisor. What's their competence level, and how can they help you, and do they understand tax law?
And are they worth their fee?
Right. I mean, that's what it comes down to.
Right. And if they're not, then then don't use an advisor. If they are, then use one.
Right.
So I don't know. I think there's a lot of really, really good financial advisors out there, and it's now that. Well, just because I think most advisors, I've been in this business a long time. You've been in this business a long time. We've seen some bad eggs. Of course we have.
Sure.
But for the majority, in my opinion, I think there's a lot of really good financial professionals out there that do really good work. But then now you're getting this other group coming in the sense of saying, hey, now I'm a fiduciary, but I have zero experience. I have no idea what taxes and things like that. But it might be in your best interest, but I don't know what the hell I'm doing. I don't know if that's in your best interest.
That doesn't sound like it's in your best interest,
does it?
does it?
So. I don't know. Right here, invest in index funds. Okay, well, yeah. We believe that, having a passive approach, low cost is a way to go, but you have to structure the portfolio appropriately for their given needs and wants and what type of income they're trying to generate.
Right.
And try to save money in taxes along the way and making sure that you have the appropriate sales strategy, rebalancing, tax management, tax loss. I mean, there's so much more that goes into this versus, touting, hey, I'm working with dimensional fund advisors and I'm a fee-only planner, so you should work with me.
Right. Yeah, that's to me again. That's a baseline. That's your starting point.
So, and I don't know. I just listened to this guy on the way into the office or in the way into the studio, and
got you riled up.
Did it?
So now we're off schedule because that.
I know the whole segment shot.
Our first segment says brief discussion about how retirement has changed.
Retirement has changed, Alan. It has changed. We're living to age 100.
Got it.
All right. So next segment. All right, we're good. Just getting started. Show's called Your Money or Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson, Big Al, hanging out. Thanks for tuning in. Check us out online if you'd like at purefinancial.com, P-U-R-E financial.com. Log in to our podcast, too. Podcast, Al.
Yes, we're big time.
Big time on the podcast. Your Money, Your Wealth. iTunes.
You can go into iTunes and type in Your Money, Your Wealth, and there we pop up.
But made it a lot easier.
Yeah.
Because sometimes it's hard to figure that stuff out.
It is.
You can just go to Pure Financial Advisors, go to the podcast section of the website and say register here, put in your email address, and all of a sudden you're registered.
Oh, that's
Boom, then
easier.
it comes to your phone or something like that. Right. I don't know how it works.
Right.
But that's what I was told.
Do you have the podcast, our podcast, on your phone?
No.
You don't?
Hell no.
I do.
I listen to a lot better
shows than ours.
That drive me nuts.
I have to fast forward our show.
Oh, it's awful. It's awful. Hey, age 100, Alan. That's the new 60.
Well, maybe not 60, but it's the new 80.
Yes, right.
We do find out that we are living longer, right, Joe? So here's the stats, and they're changing rapidly. Yes. 2015, there's about 451,000 people in the United States over age 100. They call them centurions.
Yes.
And by 2050, they estimate it's going to be about 3.7 million.
Wow.
So quite a bit more. Although, before you get too carried away with this, at the moment, there's only about 7 centurions per 10,000 adults. So it's not like it's a huge
epidemic.
But it is growing, because by 2050, they think it's going to be about 24 centurions to 10,000 adults.
Huh.
Yeah.
Huh. What's the oldest person you know?
The oldest person I know, gosh, let me think. She just passed away.
So that doesn't
She was
count.
94.
That doesn't count.
I'll have to think about that. How about you?
Yeah. That's alive.
Yeah. Me?
Probably. Yeah. Big Al. I don't know. Probably high 80s. I would say
Yeah.
high 80s.
Yeah.
My grandmother died at 95, 94.
Right.
I remember a birthday party a few years back. It was, she was still drinking beers and smoking cigarettes.
Sure. Yeah.
We had to go to the VFW in Tucson, Arizona. It was just the dirtiest place ever.
That was where the party was?
Yeah, because you
Okay.
could smoke, I guess. So she had to have
You're
her
allowed to
cigarettes.
smoke in the restaurant. Yeah.
No, but in the VFW, you
Oh,
could.
yeah, right. Okay,
Yeah.
got it.
90.
Yeah.
Partying like a rock star. It's like,
Yeah.
oh, Grandma, go for it. I was like,
Well,
well,
I
are you thinking
just-
about quitting smoking? She looked at me like I was crazy.
Yeah.
She's like, I'm 90.
There's life expectancy calculators out there.
Yes, I
Yeah,
do
and
believe
I just took one actually last week, as a matter of fact.
Okay.
And
You took one last year, too.
I did. Now this one was better though.
Are you
one
living longer now?
Yeah. Well, it's a much better calculator. Well, the one the first one I took maybe a year ago, it asked me like 2 questions and then spits out the answer. This one was pretty in depth. I mean, how many beers do I drink a night, and
Really?
do I smoke, and what do I have high blood pressure, and all this stuff. Anyway, I'm going to live to 94. It says.
Huh.
Yeah, so I'll be around a while.
All right.
Yeah.
Sounds good. How many questions did it ask you? Did it take you an hour?
I had half an hour, I bet you. I was probably 50, maybe not 50 questions, but probably 30 questions at least.
Wow.
Yeah, maybe more.
Do
Yeah.
you need to know your blood type?
No, didn't need to know that, but you have to know what ailments you have.
I got it.
Or family history.
Sure.
Yeah, right. So anyway, that's pretty good. But more importantly, did you know, Joe, there's a new world record in the
100-yard dash?
100-yard dash.
Yeah,
Yeah, Ida Keeling.
I read that.
Yeah, she's broke the record for 100-year-olds. And this is recently. This was in just a few weeks ago in Philadelphia in the Penn Relays. And so she ran the 100-meter run in 1 minute and 17 seconds. And that was the world record.
Wow.
And what's funny, I watched it on YouTube.
Oh, you did?
Yeah, because everyone was over 80 and above.
Okay.
So the real winner was Ed Cox. He was 88 years old. He finished in less than 18 seconds. That
Really?
guy was whipping by, and some other older guy was behind him, and then there was another wave of people, and then all of a sudden there was this kind of slow gal. I thought, oh, that's got to be Ida, and she caught, and then no, she finished the line, and then way in the distance, there comes Ida, just a little
Trotting along, huh?
power walk.
Well, that's cool.
But
100
she
years
made
old?
it. 100 years old.
And
yeah.
her coach was her daughter, right?
Yes.
So her coach she's got to be 80.
It's got to be up there.
Right.
It's probably 70s anyway. Yeah. So anyway, so you can break records even when you're 100, huh?
Yeah, I read she started running like in her late 60s.
Yeah, 67 is when she started running. She started doing 5Ks at that point. And here's the secrets. Her secrets. Eat for nutrition, not for taste. Okay? You do that?
Yeah, I do. I do. I don't know.
All right. Do what you need to do, not what you want to do.
Oh,
That
okay.
doesn't sound like you.
That stinks.
And make sure you exercise at least once every day. Yeah, you pretty much do that.
I do. I do exercise.
You're good at that. So there you go.
Yeah, I got a pretty good diet on Monday through Friday.
Yeah, for a 5-day good diet?
Yes.
The weekend doesn't count.
Yeah, wheels come off.
Mulligan. Yes. Got it.
So, we're just going to be way behind now.
We haven't even finished the first segment, and now we're done with 2.
All right, well, Aaron, let me bust through a couple of different things that I found interesting. This was by Jonathan Clement. He's a great writer, and now he writes for Financial Planning Magazine. And he goes, are your clients sabotaging their overall retirement? Ooh. So there was a couple of different quick things here, realities versus myths.
Okay.
And I'll just share 3 quick realities, and then I'll come back and talk a little bit about the myths. But the reality 1, clients retire with, and of course he's writing to financial advisors, clients retire with the nest egg they have, not the one they want. So how true is that, right?
It's true.
Is that when you look at people's savings, right? Is that, all right, well, here, I want to retire at a certain age, but they really don't understand how much money it's actually going to take them to provide them a retirement income stream to last them the rest of their lives. And I think most of the time they find out too late, where now they're retired and they start taking distributions from their overall retirement account, and they're like, well, wait a minute, this is not going to last me nearly as long as I anticipated.
Yeah, I had 100,000, I got 90, 80, 70,
right.
60.
It's like, where's the money going?
Yeah, and I'm not even a year in.
Yeah, exactly. What the man? Maybe having a distribution strategy might have made some sense. Number 2 is a withdrawal rate of 4% or less may be prudent, but it simply isn't enough. You know, you take a look, you got $1 million right now. If you look at Dr. Fowl that we had on this.
Wade?
Yeah, Wade.
Yeah.
He's like, all right, well, here, it's probably closer to 3%, 2.85% in his last study.
Is what he came up with.
All right, so you save $1 million, right? You're a millionaire. You could produce $28,000 from that overall portfolio.
Yeah, now that's conservative, but that was what he came up with in his study.
You don't think people are going to be a little bit disappointed? Wait a minute, Clopine. I got $1 million. You're saying I can only spend $28,000?
I want to spend $100,000 a year.
I want to spend $100,000 a year because that's what people think. They can spend about 10% of what they want, of what they have.
Right.
Because, average rates of return, but you know what? I want to deplete the overall asset. All right. We'll be back in just a second. Show's called Your Money or Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money or Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with my partner, Alan Clopine. He's a CPA. We're talking about retirement planning. Whole bunch of good stuff today. Don't fall for these 3 retirement myths, Alan.
Okay.
When you approach retirement, there's some myths out there.
Okay.
Number 1, you'll spend less.
So you may not spend less.
I don't think so. I think most of our clients, and we have, 1,600 clients, and we probably helped another few thousand on top of that. I would say most of the people that listen to this radio program, when they retire, they'll probably spend a little bit more money.
Yeah, I would say so too, particularly, Joe, in the first few years when they want to travel more.
Right. You got all this time.
Right.
It's like, now what do I do?
Yeah.
Shop. Number 2, you cannot live off of Social Security alone. The reality is Social Security is only designed to replace about 40% of your pre-retirement income. Since your living costs won't necessarily go down in retirement, relying on Social Security alone will leave you with a 60% gap. You have to figure out what is the game plan, because, we talked about this in an earlier segment. It was like, people's nest egg is a lot smaller than it needs to be, but they don't realize it until they start tapping into it.
Right, until it's too late.
Until it's too late.
So, and a lot of people then end up going back to work, which isn't...
Because, if you think about it, $100,000, $200,000, that's a lot of money, right?
Yeah, you would think so.
A lot of people don't have a couple $100,000 sitting in their checking account.
You're at $200,000, Joe, you're well ahead of the averages.
Right.
Well, because we know the average is below 100,000.
But that's not nearly enough for most people that listen to this program.
To live the lifestyle that you want to live.
Sure.
Right? Because, we use the 4% rule of thumb, and as you mentioned before, that might even be too high, but 4% rule of thumb against $200,000, that's $8,000 per year is all you can spend, and have that likely last for at least 25 years.
Yeah.
That portfolio.
Here's probably the biggest myth, is that you won't have to pay taxes.
Yeah, actually, it's interesting. We do hear that a lot. I think a lot of people know that they put money into their 401k, and when they take it out, they got to pay taxes. But I got to tell you, I'll bet you a third of the people we talk to are shocked that they have to pay taxes on their 401k income.
Right. It's like, well, I thought it was his capital gains, or I thought.
Yeah. Wait, it's retirement. Why do I have to pay taxes in retirement?
Right. I always thought I was going to be in a lower tax bracket or pay very little money in tax.
Yeah.
And what we're finding is that taxes are probably one of the largest expenses that people pay in retirement. And then we get a lot of calls over the last couple of weeks when it comes to the taxation of Social Security, because it's this funny thing. And there's been several different academic papers, and the Journal of Financial Planning just did a really good another white paper on it as well. And they're calling it the tax torpedo, right? Once you get into these certain thresholds of income, your Social Security tax or the tax of your the taxation of your Social Security can go up to 50% or 85%, or 85% of your Social Security is subject to tax. So what happens when you add $1 of income, then another $1 is added to the overall equation, which blows up your tax bracket in a significant way. So you have to have a little bit of a plan in place to avoid some of this crazy taxation when it comes to Social Security.
Yeah, and that happens because you'll be in the 15% tax bracket, which you're thinking, all right, that's not too bad. And plus, Social Security, at worst case, 85% of that is taxable, and that 85% is taxable at a 15% tax rate. So you're thinking, all right, and plus, Social Security income is tax-free in the state of California, so that's pretty good. So you're thinking, this doesn't sound too bad. And then you retire, maybe at your age 67, and that's the main source of your income. Maybe you got some savings. You're living off savings for a while until you have to start tapping your IRAs, your 401ks. And so you think, wow, this whole thing about retiring and taxes really are lower. And but then here's what happens. You hit 70 and a half, and then you are required to take money out of your 401ks and your IRAs. That's a required minimum distribution. Starts about 3.7%. Let's call it 4%. So if you got $1 million in your 401k, you got to take out about $40,000. And here's what happens is now all of a sudden that Social Security income, maybe a lot of that wasn't taxed because you didn't have very much income. So this not only is the $40,000 required minimum distribution taxed, but that income makes a bunch of your Social Security income now suddenly taxable. So no, you're actually not in a 15% bracket. In fact, when you do the math, you'll take a look. Yeah, I did pay 15% on that $40,000, but now I'm paying another between 7 and 12% on the Social Security. So in some cases, we see people in a 28% tax bracket, even though they thought they were in the 15% bracket.
Right, double.
And you are in the 15% bracket. It's just that with this extra income, more of your Social Security income is taxable, and that's the weird thing. So an extra $1 of income from your IRA makes maybe up to 85 cents of your Social Security income taxable. That's why we get these crazy tax brackets. And so what people ought to be looking at, for all people, but particularly if you've just retired and you're not yet 70 and a half, you got to start looking at getting money out of your IRAs and your 401ks. You got to put it in a Roth IRA. That's called a Roth conversion. And it's not widely known yet, Joe, that anyone can convert. You don't have to be working.
Right.
You can, when you're retired, you can convert. Now, you can't contribute. That's different. You have to be working to contribute. But to convert, that's taking money out of your IRA, 401k. You can convert that at any age, at any income level. That's new too. 2010, before that, they said you had to make less than $100,000 to do a conversion. And so a lot of you are thinking, well, my accountant always said I didn't qualify. And that could be true, but now everybody qualifies and everybody should be looking at it.
Right, because when you look at the taxation on Social Security, it's based on provisional income. Right? And so what provisional income is, your modified adjusted gross income with add-backs. The add-back would be half of your Social Security benefit plus any municipal interest and some other miscellaneous stuff. But what is not included in that is what? Roth IRA income.
Correct.
Right? And if you tax manage, let's say if you have a trust account or personal account, if you tax manage that appropriately, some of that income could come to you tax-free, right? And so you have to have a withdrawal strategy, understanding how taxation is going to be on your Social Security. And you can set yourself up in such a way where you can avoid some of this like tax torpedo. The provisional income, if it's between $25,000 and $34,000 as a single filer, 50% of your benefit is subject to tax. It's 32 to 44 as a joint filer. Once you're over $34,000 or $44,000, then 85% of your benefit is subject to tax. So if I'm looking at, hey, if I have a benefit of Social Security of $40,000 with my wife and I, right? So $20,000 a piece, that's $40,000. So they add back in $20,000 into my provisional income. But now let's say if I can create another, let's say $10,000 from my retirement account, right? That would not be included. But plus you have your itemized deductions, exclusions, and exemptions. So you could probably pull out a couple of different, just maneuvering your assets in a way where you potentially could get yourself out of the whole Social Security tax torpedo if you do the right planning.
Yeah, that is right, Joe, and that really it's the kind of thing if you're it works best if you're maybe in your 60s and you got several years before 70 and a half. But there's also strategies if you're in your 70s right now. We've seen numerous strategies to at least take a little bit out each year, and so there's maybe a little bit of pain for a little while, but you're already over this tax torpedo threshold. And then what happens is now you can start getting below it by getting some Roth conversions, because you're right, most everything is included in provisional income except Roth income. In other words, taking money out of a Roth IRA is tax-free. Taking money out of your savings account is tax-free. If you sell stocks at a gain and you have other losses that offset against that, that's tax-free. There's lots of ways to create tax-free income to keep less of your Social Security taxable. But you just have to understand what those strategies are.
Yeah, you look at the threshold and you say, okay, well, here, I have this much room before I hit that provisional income mark. Right, where then 50% or 85% of that number is going to be taxed. Well, maybe you can't get, maybe you just stick at the 50% tax. Well, 50% tax is a lot better than if 85% was taxed.
Yeah, you bet. And it's, to me, when you're talking taxes and Social Security, income distribution strategies, it's all about taking control of what's rightfully yours, right?
Got to take a break. Show's called Your Money or Wealth. We'll be back in a second.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm with Big Al. Thanks for tuning in today. Go to our website if you like at purefinancial.com. Get a little bit more information about us. We are a fee-only registered investment advisor. I'm a certified financial planner. Big Al's a CPA. We manage about $1.3 billion of client assets. So there's more accolades and all that other stuff. You can kind of browse our website to learn all about the great accomplishments of
We have a whole section on our accomplishments, don't we?
Yes.
On the website, yeah.
Yeah, it's our Dig Me page. What's it called?
What?
Have you never heard of that?
No.
Oh, you don't got a Dig Me wall?
Dig Me at home?
Yeah.
All my certificates
your eighth place medals.
Yeah, I was 8th place in 1967 on the 100-yard dash, and there was 12 participants.
Oh man! So we're talking retirement, and I found this other. I don't know if you gave me this. I don't know where I got this, but I have U.S. News says don't despair. If you're a little bit late to the party, I'm going to give you some ideas to really beef up your retirement account.
Okay, I like that.
Okay? So it's like, all right, well, how do we beef this thing up, Al? Well, first of all, if you're in your 50s and 60s and you don't have anything saved, there's probably a reason for it. But this is U.S. News and World Report. This is their advice to you. Number 1, stop spending so much.
Okay.
It's like, really? These articles, they just really dive deep. They just come up with great solutions. This is how you beef up your retirement. Stop spending.
Okay.
All right.
So that's like getting healthy. Exercise. Okay.
All right.
Check.
Done. All right. Take advantage of catch-up contributions.
Okay.
This is interesting, though, because I think a lot of times with 401k plans that they do have the catch-up contribution, but you have to elect to do it. Because $18,000 is the maximum allowable for a 401k plan through your employer. However, if you're over 50, there is a catch-up provision with an extra $5,500, right? Or $6,000.
$6,000.
Yeah. So now you get up to $24,000. But you might have to elect to do the catch-up if you're over 50, even though you want to max out the plan.
Right, that is true. That's actually true of our plan at Pure Financial, and it's if you look at, and you probably have this too. You look at your pay stub, and it has the regular 401k, but then it has the catch-up 401k. And if you have not elected to have any percent of your pay for the catch-up, it's going to stop at that $18,000, even though you want $24,000 withheld.
Yeah, and a catch-up is nothing different. It's not a different investment.
Yeah, it's the same thing.
It's the same thing.
Yeah.
It just allows you to put more money into it.
It's just I guess the way a lot of payroll companies do it is they treat it in kind of a separate bucket, if you will.
Right. And so sometimes they're like, well, no, I'm doing the catch up, but I'm not doing the normal one.
Right, because it earns more. Now it goes into your 401k, and it goes however you decide to invest it.
Yes.
I don't care whether it's the regular or catch-up. It's the same.
It's the same. Also, they changed the rules on this many, many years ago. It's not a percentage of income for a 401k plan. It's dollar for dollar. So it's like, yeah, I'm maxing my plan out. Well, you're only putting $12,000 in. Well, no, I'm putting 20% of my income.
That's the most you can do.
Well, no, you can put $24,000. Well, are you sure? Well, no, is it a top-heavy plan, or you work for a small company? No, you work for General Motors.
Right.
You could put $24,000 in.
Right.
Open a spousal IRA, Al. This is kind of cool, too.
Yes, I agree with that.
Where a spousal IRA works like this is that, let's say your spouse is working and you're not working, or vice versa. As long as there's earned income, the non-working spouse can still contribute to a retirement account.
Right.
So that's pretty cool. So if, let's say, hey, I want to put some money into a Roth IRA. All right, well, my wife's working, I'm retired, or maybe I'm laid off, or whatever, and we have some money that we want to continue to save. Just because I'm not working, that doesn't mean I can't save into the plan as long as I'm married and my spouse is working. Both spouses can contribute to the plan. Also, they can contribute. You can contribute to an IRA account even though you maxed out your 401k.
True.
So if you have a 401k plan, you put in the $18,000, you put in the catch-up, right? Another $6,000. You could still put in another $5,500 into an IRA, or another $1,000 on top of that if you're over 50, $6,500 into a Roth IRA or IRA, whatever your choice is, depending on what your circumstances are. But the point is that you can still contribute to a retirement account even though you have a 401k.
Yeah, and how about this one? You set up a side business that's profitable. You can also set a SEP IRA up as well. So
the maximum allowable for a defined contribution plan is $52,000.
Yes, unless you're over 50 and you have a 401k plan, that's $59,000 because of the $6,000 catch-up.
Right?
Yeah.
So there's a lot of things that you can do, but most people, no, I'm maxing it out.
Right.
I got 12 grand in it. No, you can put more. So how about invest your money more aggressively? That's another point.
Okay.
You got to be careful there. When you're pretty close to retirement, you want to make sure that you have the right balance. And this is what drives me nuts too. How our firm looks at investing, okay, it has nothing to do with the client's risk tolerance in a sense. It is the demand, the need for the overall portfolio, what it needs to do to create the retirement income. And right? So it's not like, what is here, fill out this 5 questionnaire. If the market goes down, how do you feel? I feel like crap. When the market goes up, how do you feel? I feel great. Okay, well, here you go. You should be 80% equities, 20% bonds, and here's the paperwork.
Right.
No, that's nonsense.
Because you got a score of 26 on our thing.
Yes. So that means this is the portfolio for you. No, you have to do financial planning. You have to take a look at what is the income coming in, what's the expenses going out, how much money needs to come from the overall portfolio. If you're pulling out more than 5 or 6% of the portfolio, it's like, no, you cannot retire. You have to reduce your spending. You have to work longer. We have to figure something out. It's not like, here, let's make a high-octane portfolio for you to try to get 9%, to get you a 6% distribution rate. It doesn't work that way. You'll run out of money. It's looking at, okay, well, let's say your distribution rate is 2 or 3%. Then you formulate a portfolio based on that income need, right?
Sure.
Then you're looking at the science behind the numbers to get the right portfolio that's specific towards the individual versus asking a couple of questions how they feel about volatility.
Well, and we often talk about investing should be towards your own goals, and that's what that means. What that means is, what do you want to spend? What sort of portfolio do you have? What rate of return do you need? All right, well, that's your goals. Maybe you want to set aside some for a vacation home or motorhome or whatever. Then you pull that out. What do you got left, and what kind of need? All right, I need, as you said, Joe, 2 or 3% rate of return. All right, well, then let's devise a portfolio to create that with a little buffer, with a little cushion, of course. But why shoot for a 15% rate of return if all you need is 3? You're just going to be taking a lot more risk. It's going to be a lot more volatile. You're going to be a lot more upset because this thing's going to be like a roller coaster.
Right. Well, you want a pension plan. Let's say for all you teachers out there, CalSTRS, right? It's not like you're going to go into the pension, the guys that or gals that are running the pension and say, here's my temperament for risk. They're going to say, get out of my, I don't care. We're running this pension to provide a certain rate of return for the pension to get the income that we need, right? And so that's how you should look at it, because then you get a lot more discipline in the approach. It's more scientific in a sense versus kind of emotion-based, because when it comes to emotion-based, you know what happens. A couple of others is buy real estate. Big Al's been a real estate investor for, 25 years or so, 30 years?
Yeah, 30 years this year.
And consider a reverse mortgage. Reverse mortgages have come a long way. I think we might get an expert or something like that on reverse mortgages here in the next couple weeks or so, just to talk about some different things.
Yeah, I would agree with you, Joe. They are, and of course we don't sell them, so we can be real honest here. I think they've come a long ways. The reverse mortgages of maybe 10 years ago, I would say most of them were terrible. You could have one spouse pass away and the other spouse gets kicked out of their home, right? All kinds of weird stuff could happen. But now they've solved a lot of those problems, and we don't necessarily recommend it in any case or even many cases, but it is something worth looking at, particularly if you got a lot of home equity.
Absolutely. Got to take a break. Show's called Your Money, Your Wealth.